What's up everyone, it's the first Friday of the month, so time for a new investing video from PerFinEx, the #1 English speaking and independent financial planner in Germany. Today with episode number 11 already. So next month we are celebrating our 1-year anniversary together. Can you imagine this? It's been a hell of a ride, huh? Maybe not what we wanted, but life isn't always what you want. The background picture is a bear today, 2 bears in fact, because we are officially in a bear market since the start of last week. Meaning the global stock market is down by more than 20% from its peak. Our 3 portfolios are performing a little bit better, but it's still not pretty to be honest. That's why we made major updates last month in order to adapt to the changing market conditions. In fact, the biggest portfolio update since the start in August last year. What did we change exactly? Let's check it out together. While the last videos came with a lot of learning and education, like the 3 investing rules during a market correction from Peter Lynch in the last video, this video will be mostly focused on the big portfolio updates. It's not a market correction anymore anyways. We are now in a bear market. What's the difference? Let's take a look. Remember this chart from last month's video? We learned that there were 29 market corrections since World War II. So 1 correction on average every 3 years. What's a market correction? It's when the stock market declines from the peak by more than 10% or more. And that's what we had until the beginning of last week, a market correction. And since a market correction takes on average 4 months to be over, as you can see in the chart, I said, statistically speaking, in the last video, that it could be over already. Now since last week we are officially in a bear market. And what's that? The stock market declining by 20% or more from its peak. That is of course a lot more severe, and as you can see in the chart, it doesn't happen that often. While a market correction happens once every 3 years, statistically, a bear market happened 6 times since World War II, so 1 bear market every 12.5 years. Statistically. A bear market also takes longer than a market correction. A market correction would, statistically, be over already. Our current bear market will last until October this year. Statistically. Why am I emphasizing the statistics so much? Because nobody knows the future. The bear market could be over already. It can also last until early next year. Nobody knows the future. And past performance is no guarantee for future results. Just one thing's for sure, a bear market that happens once every 12.5 years has to be exactly in the year that we start our community investing. My life. At least none of our portfolios lost 20% up to now. And with the changes we made this month, we set us up really good when the market recovers. Let's take a look. This is how our high safety investing strategy is investing starting today. Quick reminder, the goal is to give you guys an investing opportunity without facing the risk of losing more than 15% of your hard-earned money. We are now at -5%, so all in line. To achieve our goal, we have to invest a large part of the portfolio in bonds, because bonds are safer and less volatile than stocks are. You can see that roughly 60% are invested in bonds in order to stay in our risk category 5 on the German risk category investing scale. The bonds are mostly stable in terms of interest rate changes. That's what you can see here with the 59, not quite 69. A shame. That was especially important to us as the world is currently going through a phase of increasing interest rates again. And our 40% stocks are mostly invested in large companies with a slight focus on value companies compared to growth stocks. Again, we don't want to lose more than 15% in this investing strategy. That's why value companies are a better fit than hype growth stocks. That's more in the other 2 portfolios. How are our stocks invested? Here you can see the sectors. Nice distribution between cyclical, sensitive and defensive. With a little more percentage in the financial services and the technology than we want it to be. But that's very tough to get down, for sure. Not sure how you guys do it in your personal portfolios, because financial services and tech is just everywhere. How would that portfolio have performed in the past? Let's be honest, that's what all of you guys want to know, right? Okay, I'll show it to you. Under one condition, we remind ourselves one more time that past performance is no guarantee for future results. Here it is over the last 10 years, that's how much we can go back with the software. 10,000 euro invested, end of 2012 in this portfolio, would be about 22,000 at the end of last month. That's minus 7% this year, plus 6.6% each year in the last 3 years, and 0.44% over the last year. Again, not what we want it to be, but apparently that's what we deserve in this DNH. That's how the portfolio developed last month, still with the old distribution, of course. When you log into your Fidelity investment account today or on Monday, you should already see the new distribution. Last month we were down 5.5%, bringing us to an overall loss of 8.5% before dividends. 8.5% is still less than 15% according to my basic math skills, so all good anyway. June was the best dividend month in the history of the portfolio up to date. 10,000 euro invested last August, which was the start, would be 9,163 euros portfolio value today, resulting in over 125 euro dividends in June, which is ridiculously good. The dividends and interest payments are also the reason why our high safety investing strategy performed okay-ish so far. Minus 8.5% in portfolio growth, plus 3.8% in dividends, resulting in minus 4.7% total return since August last year. Let's talk about our most popular investing strategy, passive income, as that is probably the most interesting part of the video for most of you guys watching. The term passive income is pretty self-explanatory as well, so I think we can skip explaining the investing goal here. Right? We are investing in stocks only here, not a single bond. Why not? Because I don't really like bonds in these times, which you know if you've seen some of our investing videos. Sure, interest rates will increase in the near future, but remember that interest rate and bond price is usually a 1 to 7 lever. If you increase interest rates by 1%, bond prices fall on average 7%. In the prior investing strategies, we have to invest in bonds. Here, we don't have to, so we don't do it. And as we want a lot of passive income here, of course, we are investing most of the portfolio in large value companies that pay us a reliable dividend. That's what we are looking for here. Reliable, quality dividends. We are not interested in super high dividends that companies have to cut in times like these. No, we want quality dividends here. And here you can see the sectors that we're investing in. The biggest change in this investing strategy is that we significantly cut the real estate portion down to 6.81% only. I talked with some of you about the real estate ETF and most suggested also to cut it, even though it's still a mystery to all of us why it's going down so much. Seems like we haven't figured out the puzzle completely yet. Maybe you guys have some input in the comments. Anyway, if something's not performing, we have to get rid of it. Holding on to investment that keeps losing is no solution. Hashtag Wirecard. While the chart with the historic performance is loading, you can remind yourself again that past performance 10,000 euro invested in 2012 would be roughly 30,000 euros right now. Tripling your money over 10 years equals roughly a 10.7 rate of return over the last 3 years. Over 1 year, this portfolio would still be up by 10%, since the start of 2022, down 1.66%. And now let's come to the real return. The old distribution that was valid until yesterday returned last month minus 6%. Ouchie. Looks a little bit like a bottom since mid-month, does it? That's also what I said in last month's video before everything went down even more. Since the start last August, we are down -8% before dividends. And with the dividends that we got in June, to keep our streak going, we are realistically down -6%, including the 2% dividends that were paid out to you guys. Cutting the real estate ETF is certainly the biggest change we did to either of the portfolios. So I'm very excited to see how this portfolio develops going forward, if the market recovers in summer, or if we go down even further until autumn or winter. We'll see what happens. High return investing strategy. Here I must honestly admit that we've tried to be a little fancy for you guys. Especially with the power of private equity and the buyback achievers that were a little too fancy for current market conditions. Maybe we'll come back to these investments once the market recovers, maybe not. But certainly for current times, it's not the right way to invest. That's why we cut these ETFs and replaced them with more, let's say, traditional investments like the Nasdaq or emerging markets. It's all stocks, of course, because we want a high return, and the high return is certainly not happening with bonds. Again, nice distribution when it comes to large companies, and here a slight shift towards growth companies. You can see the difference, especially when comparing that with the other two portfolios that are investing more towards value. The sectors may be surprisingly tilted towards defensive for a portfolio that is called high return. That's because the largest sector of the portfolio is healthcare, and that is considered to be in the defensive sector for whatever reason. The historic return of this portfolio is the highest out of all three portfolios, because return comes from risk. 10,000 euro invested in 2012 would be 33,500 euros last month. That's a 13.26% rate of return over the last 3 years, 8.15% over 1 year, and almost -5% since the start of 2022. But you're not getting greedy seeing this, because past performance. Exactly. High return comes from high risk, and that's why, not surprisingly, this portfolio is down the most. -6.5% last month, with the same bottom we identified in the passive income strategy. Let's see if this will be a real bottom this time, or just a fake bottom like last month. The overall performance since the start of August last year is -14%. Ouch. This chart is getting worse and worse the longer I look at it. With 1.5% paid out in dividends. June was the highest dividend month, just like in the high safety portfolio. With the current example portfolio size of 8,515 euros, you would have gotten almost 40 euros in dividends, leaving us with a total negative return since August last year at 12.7%. Let's hope that the market recovers and we can come back to at least a single-digit loss here. I try to maintain my humor with a little joke here and there, but let me tell you, it's not fun doing these videos when all charts are red and all our portfolios are going down by the day, meaning you guys are losing money because of us. I'd rather have it different, that we all get wealthier here until we can toast with champagne together, but that's just not how reality is. Sometimes life is not what you want it to be. The only smart option we have is to sit through, because selling is not the way to go. Check out Peter Lynch's 3 investing rules during a market correction from last video if you feel like selling. Because if you should believe one guy, it's arguably one of the most successful investors in human history. If you would like to join our investing community, which could be a good time right now, correct? You can open your personal investment account with Fidelity completely online with the link in the description. It's just a couple of minutes. The regular investment account is fine, you don't need this plus account. After you registered, Fidelity will send you an invitation to identify yourself either with video ident or post ident. Please do that. If you don't complete your video ident or your post ident, your account will not be opened. In case post is super German and rejects your application for whichever reason, feel free to reach out to us and we'll try to help you. And after video ident is done, it usually takes Fidelity a day or two to open your investment account. Then we will see it because we can see it electronically, meaning we will reach out to you to set up a meeting to discuss your perfect investing strategy, and you will get your login data a couple of days later via good old German post. Let's hope the current bear market is over soonish. See you next month, investors.